Welcome to The Landscape by George Smith Partners.
Welcome to The Landscape. This is George Smith Partners podcast. Today I'm joined by my co-host, Mr. David Pascal.
Hello, everyone.
Very excited to have a special guest with us today, one of our very own, Matt Fisher. Matt is an integral part of the team here at George Smith Partners. Not only does he run our office in the Seattle area, well, it's in Bellevue to be specific, but Matt is also our head of mortgage banking. So today we're going to explore what the heck is mortgage banking. What does that mean? What can George Smith Partners do for you as a client? And a little different today than what we normally do with an external guest, but we figured that this was interesting for our clients and listeners to this podcast. So Matt, thanks for joining us.
Happy to be here. Good to see you guys.
Thank you, Matt.
Yeah, happy to get into it. Very excited that GSP is getting into the mortgage banking space. I think life companies in general are a great way to secure debt and sometimes equity. So happy to answer any questions that you guys have.
So yeah, let's get started on mortgage banking and life companies in general. Like life companies, what makes them unique, Matt? Talk about their source of funds and the reason they're able to price differently than other lenders, et cetera.
Sure. Yeah. So, life companies, major source of commercial real estate capital, and the way that they create that liquidity is by selling life insurance company policies, annuities, things like that, which is a great business. So they have lots of capital to deploy. A lot of folks, I think, may not be familiar with life companies because many do not work directly with sponsors. They also don't work with the vast majority of capital advisory firms in the United States. So traditionally, and this has changed a little bit in recent years, life companies would only operate through correspondence, meaning, in any major market, there's a handful of groups who have access to these life companies. So, a lot of mortgage brokerage firms, capital advisory firms cannot go directly to like a Symetra, for example, or a Standard Life. And the reason that they use these correspondents is there's a few reasons. One is they rely on the correspondents to service the loans that they originate. And that's important to the lender because the servicer, the correspondent, is usually the eyes and ears of that lender out in the field. They're sending annual inspections. They're looking at NOI reports. So if there's any problem with the asset, the correspondents are the first people to know. The second reason that life companies like to use correspondents is because they have very specific programs, and there's a lot of nuance and relationship to those programs. So rather than being bombarded with a bunch of loan requests that aren't a good fit for their program, the correspondents really know exactly, hey, this is a fit for lender X, Y, and Z, so I'm going to reach out to you guys for it. So that's a big reason why they use correspondence. From a program perspective, it's a lot different than a bank, a CMBS lender. Life companies are known for long-term fixed rate debt. In recent years, as they've begun chasing yield and selling more annuities, and they're trying to get more money out. Life companies have branched out from doing just perm loans to bridge, construction to perm. Some will even do forms of equity, all in an effort to get more dollars out. So, the biggest differences to people who maybe aren't exposed to it are like, your broad terms. Generally, life companies are doing non-recourse, no origination fee, very competitive pricing. Multifamily pricing today, in the low 100s on a solid, clean deal. You lock your interest rate when you sign the loan app with a deposit that's refunded to the client. So there's zero interest rate risk from the moment you sign the loan app through the life of the loan, which is great. Some life companies today will do something as short as like a 3-year term, but usually, they can go out all the way to 40 years. And the only way you can get a 40-year term outside of that is like a HUD loan that takes, a year to close, which can be great if you make it through that grueling process. So life companies, think about them in simple terms like they're very low cost, they're very low interest rates, and very high certainty of execution.
An
Great.
interesting life company process is they usually lock rate at application, which most lenders do not do.
Yep.
And there's no margin call associated with it. But it's interesting the reason why they do that. Matt, do you want to talk a little bit? You and I have had that discussion before.
Yeah. So, a lot of life companies they'll actually, it's mandatory that you lock your rate when you sign the loan app. And that's mainly to do with just certainty of execution. And if you're a sponsor and you're acquiring an asset, this is even more important, I think. But, we're in a very volatile market. Let's say you sign a loan app and it's a 60 to 70 day close and the SOFR index or whatever blows out. And now because your rate is significantly higher than it was when you first signed the LOI, your loan amount gets cut. And maybe the sponsor doesn't have the additional equity to put into the deal. So the deal dies. And these life companies are doing tons and tons of loans. Standard Life did 900 loans last year. And so, they don't want to mess around with any changes. I mean, I've always said that, like, if you sign a loan app with a life company and you lock your rate, that loan is going to close exactly as advertised on the date that they tell you it's going to close.
That's
Yeah, that's huge. Tell people what are we doing here at George Smith Partners in order to better our services for our clients with respect to life companies and the availability of those loans?
Yeah. We've been, over the last few years, quietly building out a book of relationships with correspondent life companies. We have a servicing team, and I think that the most progress, or the biggest news recently that we've got, is that we acquired the Alison company, which is a 92-year-old mortgage banking firm headquartered in Newport Beach. So, through that acquisition, we have grown our servicing portfolio to over $1.5 billion. We have 16 different lending programs that, should we originate a loan through one of those programs, we're going to be the servicer. And that acquisition also includes some affiliate companies through the Alison company located in San Diego, Santa Barbara, Scottsdale, and Las Vegas. And these are decades old relationships with life companies. And we all say this is a relationship business, but for the life company world, relationships are huge. And if you don't have the relationship, you're not going to get access to that money. So now what it means for our clients is that we can secure terms from lenders that our competition doesn't have access to, unless they happen to be a correspondent similar to us. It means that we service the loans we originate. So, think about COVID when tenants stopped paying rent and people needed deferral on mortgage payments and things like that. I had a situation where, this was a loan we had closed with a life company. It was a retail property. The anchor tenant notified the sponsor that they would not be paying rent. So I got a panic call from my client wondering, what does this mean for us? And within 5 minutes, I had got the head of servicing from that life company lender on the phone. And that kind of service that you're able to provide for a client in a time when they need help is huge. Hopefully you're never in that situation, but there's nothing worse than calling like a servicing center in the middle of nowhere who has no idea who you are and no sense of urgency or motivation to really help you out. So us being able to provide these kind of exclusive sources of capital and a much higher tier of service to our sponsors, I think, is a great tool for George Smith Partners.
Totally agree with you. I think, Matt, you've been leading this for us. You've been doing a great job. We think you're just doing it spectacularly. So we thank you for that. Tell us a little bit more about, though, like what's happening in the market right now. What are we seeing appetite for from life companies versus, CMBS or bank or even Fannie and Freddie? Like, why are people taking life company debt today?
Sure.
And maybe talk a little bit about LTV also.
That would be good.
Sure.
Yeah.
So, something to think about if you take a step back, when you look at like the default rate with varying lending platforms. It's very high with CMBS today. It's around 5.5%. Banks are around 1.5%. Life companies, their default rate, if you look at it industry wide, is about 0.5%. So these lenders, what that means, because they take a conservative approach to lending, they're not doing these really high octane, highly structured deals. What that means is even in a volatile market, they have money to lend, and people, I think, today are looking for that certainty of execution. So you have a situation where life companies have been, they're trying to get more money out this year than they were last year. They'll be trying to get more money out next year than they are this year. And they're selling annuities like crazy. So they've got money burning a hole in their pocket. And because of that, they've started branching out, and they've got a whole suite of different products at their disposal. So they're very active bridge lenders. They're very active construction lenders in the life company space. In terms of like product type, they'll lend on all the major food groups, but they'll also do some special purpose stuff. We just closed a $22 million loan on a office building with 118 slip marina, all on the same parcel through a life company. It was at a very competitive rate. I think we had 6 different life companies kind of vying for that deal. I tell people that they're never going to be the highest proceed option. Usually, they like to stick around 65% LTV, but they're really focused, I think, on debt cover. So you're going to get the most competitive pricing if you're at what they call a CM1 rated underwriting, which is usually equates to like a 150 debt cover, but they'll go down to, on multifamily, they'll get below a 120 debt cover on stabilized assets. Rates today probably range from if you're talking about a solid middle of the road deal, regardless of property type, rates are ranging from the, low 100s up to 200 over the corresponding treasury. So they don't underwrite based on SOFR. Treasury is the index that they place the spread over. And because they can offer, 3, 5, 7, 10, 15, 20-year fixed rate periods, they'll place that spread over the corresponding treasury. They like long rate, and people, I think, right now are seeing the volatility in the market, and they want some security. So, if you're in a situation where you're looking at buying a rate cap, we were just talking about this morning. This war in Iran, what it's doing to the forward curve, rate cap policies are through the roof. I had a loan where the rate cap policy went up 30 grand over a 24-hour period because Iran said, hey, we've ended peace talks with the United States. So there's a lot of uncertainty, and in a volatile market like this, a lot can happen in 60 days while you're closing a loan. So, whether it's for an acquisition where you just need to make sure that this loan is going to close on time or not, or you're just doing a refi, you just want to remove that interest rate risk and the uncertainty. And so that's, I think, a big driver outside of, all the other bells and whistles and non-recourse, no origination fee, things like that. But, I think people are looking for some kind of certainty of execution today. So that's been driving a lot of business.
Interesting.
It's also interesting that life companies in today's world, with all these debt funds and CMBS and all these loans being sold in the secondary market, CLO, et cetera, life companies are traditional portfolio lenders. Mm-hmm. They hold these loans, and they rate them with terms like CM1 and CM2, because what the life companies do is they rate the entire 10-year term of the loan. And I've had originated some life company business where the loan officer reminds me on a 10-year loan, I'll be coming out here every year for the next 10 years looking at this property, because they hold it. Yep. And they service it, or we service it.
Yeah, and they're mainly focused on the real estate. They're not a bank, so they don't care about deposits. The real estate is their collateral. They're not looking for some kind of larger deposit relationship.
They're not big on recourse.
Yeah,
usually.
So the real estate is really what they're focused on, and I think that, paired with the fact that they're regulated by the insurance commission in the state that they reside, not by the federal government, it kind of frees them up to be more flexible than a bank or a CMBS lender would be. They're much, they're not as highly regulated as some of those groups.
Interesting. So let's unpack a little bit. What advice would you have for real estate sponsors who have not borrowed from life companies in the past? And I'd love to hear what the advice is. Maybe we can unpack it a little bit.
Yeah, I think I work all the time with sponsors who maybe have worked with a number of banks, and then they do their first life company loan. And the funny thing is, it's like, they're like, this is almost going too well, or it's too smooth. They're waiting for the
Too
other shoe
easy.
to drop
Yeah.
or to get retraded at some point.
Right.
I'm like, you can just rest easy. Like this is a normal process with the life co. Um, there's nothing worse than being retraded, at the closing table, and it doesn't happen with the life companies. What I would say to people who are looking for a life company loan is, like I said, go into it with the expectation that these are not going to be the highest octane lender in the space. And really what is important is that if there's any kind of hair on the deal, or you have some rough spot in your credit history or something like that, the best thing you can do is just disclose it up front. They want to be your partner. They're extremely borrower friendly. The only way terms would change over the course of a life company loan is if a month into closing, they find out that like you happen to be in litigation or something like that.
Right.
And that's a big part of why they use us as a correspondent, because it's our job to make sure that we're presenting all the information up front. But transparency is key to building that long-lasting relationship. And the other thing I would say to a client who wants to explore the life company space is, make sure that you're working with somebody like GSP who has real direct access, and not someone who says, yeah, I could take you to a life company, and then they call a correspondent like us and say, hey, can we work out some kind of co-broker thing? Just go directly to the correspondent and you'll have real access to one of these type of lenders.
Right. And loan sizes, generally speaking, for life companies.
Yeah.
Yeah.
Yeah, that, a while ago, I think, and there seems to be a misconception that like life companies only like big deals. I've heard from a lot of people that they thought these life companies use defeasance as a prepay. So I'll just say now, since I have the platform, that no life company uses defeasance. It's either yield maintenance or a step down prepayment penalty, both of which you can, are pretty easy to understand, and you're not going to defeasewithEase.com. But loan sizes, we've got plenty of life companies that'll do, $1 to $20 million loans. We've got other life companies that want to see middle market deals from, call it 20 to 25 up to 60 or 75. And then we've got life companies that'll do large, much larger $200 million plus transactions. They're great for portfolios. We had a $180 million portfolio, when was it, 2 years ago? And just this year we did another $100 million portfolio, all made up of small class, B and C multifamily properties dispersed around a particular market. So, they're great for those. They can provide release provisions. Because their underwriting process is generally very smooth. It actually makes doing a large portfolio like that not hellacious, I could say. So, loan sizes, there's a home for just about everything, so long as the underwriting is in a reasonable place.
I think we've even seen, back to the pricing that you were discussing earlier, I think we're even seeing some sub 6% spreads right now, right? For some multi deals and industrial. Yeah.
Yeah. I mean,
Go ahead.
we had a life company quote. It was a multifamily stabilized asset. LTV was below 55%. It was a 10-year fixed, non-recourse, full-term interest only. Spread was like 106 or 107 over the 10-year treasury. I mean, that's a pretty darn good quote.
Pretty great pricing, yeah.
And
and one thing about the spread and their pricing that's a little bit trivial but interesting in favor of the borrower is that life companies use the old 3360 methodology with interest rate payments, which saves like about 6 or 8 bips off of a corresponding CMBS at actual 360.
That's right. Yeah. And I mean, we could stay on this on this
Right.
podcast for another
Forever.
3 hours just talking about the nuance, but I mean, we just got a bridge quote from a life company that's, a 3-year term, no prepayment in year 3. Rate was right around 7%, non-recourse. They can get very flexible for a good deal, and there's just so much nuance, and that's really why they depend on correspondence, because if they didn't, they would be bombarded with people who want to do business with them, but the deal may not be a right fit. We are, we meet with them in person many times a year. We're talking to them multiple times a week, every week. We're constantly asking for rate updates. If someone out there on the sponsorship side is like, hey, I just want to learn more, or I need rate and term guidance, we're constantly on the phone with them going, hey, my client is thinking about, executing a PSA to acquire property X, Y, and Z, and where would your rate and term, like your guidance be on something like this? And we'll get kind of a soft quote before they even get the deal signed up. So, I think we spend a great deal of time making sure that we're up to date on these different programs with the life company, because it changes. It changes all the time. Some of these lenders change their spreads on a weekly basis.
All right.
Yeah.
David, any other questions you got for Matt?
No, I mean, I could go on and on, but I have one more on product types. Life companies were known as major office lenders pre-COVID, but a good thing is they were low leverage office lenders. And how's that played out generally, or what product types are they hottest on now? And are you seeing any office being done?
Yeah, we're closing on a refi of an office loan today that we just did a couple of years ago with one of our life companies. Like I said, we just closed an office loan in downtown Kirkland, right on Lake Washington, with a big marina attached to it. I mean,
Right.
They're not a good
For
fit.
the right office building.
Yeah, they're not a good fit for land, but they'll do special use assets. We back in the day, I know that one of our life companies did a loan on the only theme park in Washington State. Just because the land value was significantly higher than the loan amount. So they felt pretty secure. They'll do single tenants. They love self-storage. They love mobile home and RV parks.
Yeah.
They'll do hospitality. There's I hesitate to say this, because I think the thing we all hear in this business when we go to conferences, if I had like a bingo chart of what we hear people say all the time is, hey, we're a common sense lender. We have certainty of execution. Those are two staples or common denominators of every discussion, but those things become extremely important when you don't have them. And life companies, I think they really embody that. Hey, if the deal makes sense, we'll take a look at it, and we do have certainty of execution. So, there's not a lot of property types they have a hard no on outside of like raw land.
Right. Great. So Matt, thank you for joining us today. Again, for folks that want to reach out to George Smith Partners, Matt and David, I'm sure always more than happy to take your call. gspartners.com. Of course, got to sign up for FinFacts, right, David?
Of course, got to
The
sign up for
world's
FinFacts
greatest
and read it
real
every
estate
Friday.
newsletter.
Yes.
That's right.
Am I right?
Trenchant information.
I never miss a copy.
Exactly. We try to make it interesting and apropos. So go to gspartners.com and sign up for FinFacts. Anything else, guys? Should we wrap it up?
One last thing. I just want to say that we're extremely excited with Alison Company joining our team. It's a great group. We're very honored to be able to kind of carry forward this 90-year-old brand, and we're very happy to have them. So,
and I've been working with them on a deal, and it's going well. So it's a great fit.
Yeah.
Great.
Thanks for having me, guys.
All right. Yeah.
Thanks, guys.
Thanks.